Brian, thank you very much for joining us today. Where in the world are you today?
You know, I'm in lovely Naples, Florida. I was in Toronto this week to talk about the launch of our three ETFs and mutual fund and being back in Canada. It's so exciting. But I got to tell you, man, even though I grew up in Minnesota, it was cold there. And I was not prepared. So I brought my gloves. I felt like I was back home again, but it was great to be in town. I saw a lot of great friends and great colleagues and great clients. And so it was wonderful.
Well, many people might remember you from your days at Merrill Lynch or at BMO, and they've seen you on CNBC many times, but maybe you can just tell us about your new firm and what services does it offer?
Thank you so much. Yeah, we launched Humilis Investment Strategies October 29th of last year in 2025 after 36 years on Wall Street, kind of working quote unquote for the man. And we're not in Minneapolis, by the way. We're in Naples, Florida. And if you hear a siren, that means someone had a heart attack, by the way. Anyway, and so now we are the man, meaning that we're the chief compliance officer for now. We're going to hire someone here real soon, chief operating officer, chief bottle washer, and it's there's some really great things about working for big companies, and there's some obviously some other issues, but we're very blessed and fortunate to be doing this for a long time, and we've delivered great performance for the portfolios that we ran for years and years. First at Merrill Lynch, and then at Oppenheimer, and then at BMO, and we're very excited. Our services are this. In Canada, we run, as we have for 13 and a half years, three North American equity portfolios, and then some select US-centric portfolios from an equity perspective. They're separately managed accounts. And then we've recently launched three ETFs and two mutual fund series for what we've done for several years. And so we're known as long-term investors, low turnover, high quality equities, very fundamental, not top down. And we've been very blessed and fortunate to have great performance. And I think where we're differentiated is number one, we're model delivery. So we're letting our platforms have the clients and have the assets. We don't want that. We want to provide a resource for those platforms. Number one. Number two, we grew up in the world of research. So as a sell side research analyst, and then a sell side strategist for several years out in the public domain, writing about the stock markets in first in the U.S., then global when I was at Merrill, then the U.S. again when I was at Merrill, and then Canada as well when we came to BMO 14 years ago. And it's a little different than the traditional portfolio manager who typically is an analyst first covering some stocks, and they become an assistant portfolio manager, then they're portfolio manager over 200 stocks. We've tried to keep things kind of simple and be convicted. So that's why the tagline for our firm is investing with conviction and humility. And humilis is Latin for humble. And in this business, you know this, you're humbled every day because you know that your prices change every day. So if you think you know everything, man, you don't because things change. And so you should never be the smartest person in the room. And we're clearly never the smartest person in the room. And so we try to lead with that humility and lead with that conviction in everything that we do.
Oh, that's a great overview. And I agree with you 100%. The markets, they have an amazing way of humbling you on a regular basis. And even though I've been doing this for 25 plus years, I still get humbled all the time, still learning new things. And I love speaking with people like you to learn about the markets and about the economy. So it's been, I'm sure you would agree with me when I say it's been one hell of a year already. We're only 4 months into it, and we started the year. We were so hyper focused on private equity and private credit, AI valuations, data centers, the collapse of software stocks. And then that all changed on February the 28th. And ever since then, we've been just hyper focused on the Middle East and what's happening there. We've had some big up days and some big down days, a lot of volatility, but I can't believe the S&P and the NASDAQ are virtually flat on the year. Why don't we start right here? What is your take on the S&P?
Well, we published our year ahead piece for both the US and Canada, which is all available to people if they want to subscribe at humilisimd.com or on our platforms that they're who we partner with get the research for free. We said that the S&P 500 would reach a target range of 7,300 to 7,500 this year. We're still standing behind that. What we also talked about was the market's natural transition away from being momentum and multiple driven to more earnings driven. And so you know that you watch the financial press or read the financial press or read research, all these earnings numbers are going up, man. You're like, how could these earnings numbers be going up? And according to the press or whatever, the world's coming to an end because of the things that you talked about, private credit and AI going to zero and software and all this kind of stuff. But we talked about this in our year ahead piece saying, predominantly there are momentum, valuation-driven markets, and there are earnings-driven markets. You can still have a bull market and have an earnings-driven market, but there's kind of two major differences. Number one, if you go back several decades and you look at the average annual year-over-year price change of the S&P 500, when it's an earnings-driven market where earnings really are going up, typically and historically, the return on that annual basis is roughly half what a multiple valuation driven market is. Okay. So that's number one. Number two, that means it can still be positive. However, number two, typically and historically, because investors have a hard time changing and changing their stripes from chasing the momentum, i.e., chasing AI, or chasing gold, or chasing private credit, they have to kind of unwind those positions and learn. How do you learn, Jimmy? How do you learn? By losing money and being kind of hurt a little bit and hopefully being humbled. And so typically and historically, earnings-driven markets have more quote-unquote corrections and more volatility. And we clearly have seen that. So that's how we explain kind of what's going on so far. And then in terms of the noise and all that kind of stuff, I mean, I remember when I got in the business a long, long time ago, my very first mentor, William O'Neill at Investors Business Daily said, Belski said, don't ever let anybody tell you there's nothing going on or complain about all the news. Because there's always news, there's always something going on, and that's why you need to have a discipline and a process. And that was ground into me 36 years ago, and that's how we've kind of been able to take two steps back and say, hey, let's let this too shall pass, and you can control what you can control by what you own.
So it sounds like you're positive on the market. You think it's going to continue to climb this wall of worry?
We do. I think the resiliency of this market has been amazing. I think actually when this is done, we came out in 2009 and said we're entering a secular bull market. We clarified the call in print in 2010 saying U.S. stocks have entered a 25-year secular bull market. We brought that call when we came up north to BMO in 2012 and everybody thought we were crazy. And so I think we got at least another 8 to 10 years to go on that, number one. Number two, doesn't mean that we can't have bear markets because we've had a few bear markets since 2009. But I think it's going to be choppy still as everybody kind of tries to figure out that you don't have to only own tech stocks and you can diversify out and own value, which we've been very positive on. You can own dividend growth, which we've been positive on. And I think the contrarian play, which is actually a derivative, quite frankly, on private equity and private credit is small mid-cap stocks. I think small mid-cap stocks are kind of the forgotten asset class, and fundamentally, they look amazing, but nobody cares because of the performance. So for me being at heart a contrarian, that's one of the things over the next 5 to 10 years in U.S. stocks and in Canadian stocks for that matter that really excite me.
So you touched on private credit and private equity, and before we dive into your names, I just want to get your thoughts on this. And recently, the Ontario Teachers Pension Plan came out with their 2025 performance numbers. They were up 6.7% on the year. And just to put that into context, the TSX was up 30% on the year. The S&P was up 16% on the year. And they came out and they said they took big write-downs associated with private equity and also real estate. Now, we don't know how long they were sitting on these private equity investments for. We don't know any details about the real estate, what countries, what cities they're focused on. But we're seeing a lot of other companies that have come out here in the last few months with expressing concern about risk issues. Blue Owl
Yep.
Capital, for example, they came out in the month of November. They said they were going to stop redemptions. That stock is down 65%. KKR is down 30% on the year. Blackstone is down 25%. Do you think these concerns that we have about private credit, do you think that's going to be an ongoing issue? Do you think it's going to be like an 08, 09 scenario?
To some degree, I do believe it is. And it actually is good that we're seeing this type of visibility from Ontario teachers. I think that's in pension. I think it's fantastic that they came out and said that. They don't like the performance, obviously, and that's massive underperformance from someone that prides themselves, quite frankly, as being fundamental. And being have them being institutional clients of mine when I was on the sell side for several years. But I'm not surprised. And here's why I'm not surprised. 2020, 2021, money was free. And when you're talking about interest rates literally below 1%, that was like, here you go. And that was really where the big momentum went into private credit and private those kind of private equity type of scenarios. And I continue to fear that, because the bottom line, when you know what hits the fan, people need liquidity. And there's no liquidity in those names. And I remember back in 2008 sitting on the phone with some very big clients private wealth clients at Merrill, and the financial advisor was telling me, don't tell them to sell, Belski. And I'm like, I got to tell them to sell. And I saved these people, 20, 30, 40%. And what were they selling at that time? What was the big alternative investment at that time? Hedge funds. And so I think in life, the more complicated you make it, the more issues you're going to have in life. I think investing is like life, and life is like investing. So I think a lot of family offices and very high net worth people, they get really excited about 100-page decks that talk about the income streams and return streams of these very quote unquote sexy private equity, private credit stuff, but they don't really talk about the risks. And it's the same thing happened in hedge funds, if you remember. And so I think there's going to be a washing out of this. Let's stick with the humility brand. I think they're going to have some humility. Full disclosure, we own Blackstone for several years, but we sold it a few months ago, because although we do believe that company out of the others, because of the market cap, can weather through some of this, but we don't want any direct exposure to that in our portfolios. So we blew that out. I do believe the banks have been unjustly hurt because of that, the big banks in the United States. And I think that's provided a great buying opportunity. Hope we can talk about that in terms of why we like financials. But I don't think it's a canary in the coal mine, if you want to go with that. I don't think it's systemic. I just think there's going to be some issues. And so that's why, let's go back to the very beginning. I think what Ontario Pension did was very smart, and they were very clear about it. And they came out and talked about it, and hopefully people have calmed down. And so that's kind of more of an orderly transition to hopefully kind of get out of these types of instruments.
Yeah, and I kind of wonder how many other pension funds around the world are under the same sort of situation where they're sitting on these massive losses, especially on these illiquid assets that can't be marked to market. And
Correct.
they're going to be taking big losses here in the coming year.
You know, the best book I ever read on investing, Jimmy, was The Art of Contrary Thinking. And has nothing to do with investments, by the way. It's think differently if you have the analysis to back it up. So, and I'm going to get some hate letters for this, so bring it on. How many times have the consultants, have you heard in our business, the consultants are coming in and they've got these fancy presentations and they're going to tell you they're going to make you all this money. And then people are like, oh, yeah. Or at the same time, they could have owned, think about this, man. You could have owned these amazing companies in Canada, in the United States, like Shopify and Nvidia and Spotify. And even look at Aritzia, one of my favorite names in Canada. If you would have just bought those stocks in 2021, think about your upside. And so again, shoulda, coulda, woulda. But anytime in my history of my career, even in the mid 90s, when you hear the consultants are coming in, and they're going to tell you this, oh my gosh, go the other way. And so we've been able to kind of use that as actually an investing indicator, and it's actually worked out pretty well.
Okay, so why don't we dive into some of the sectors and names that you like? You mentioned that you like the financials. Why don't we start right there?
We do. So, we're longer term thematic thinkers. And I think if you look at financials, I remember when I worked at Merrill, and then the last year I worked at Merrill Lynch, I moved back to the Twin Cities of Minneapolis, St. Paul, and moved back to a suburb of St. Paul. And I didn't tell anybody I was working for Merrill, because that wasn't, I work in finance, and there was so much negativity surrounding the financial companies. And then the TARP came, And then we've seen all this hullabaloo and news about the Fed and nobody trusts the big banks and for a long time. And I think that self-corrected them. They became very cheap. Remember, in the United States, we have 4,000 banks. 4,000 banks is 600 publicly traded banks. And so, from a thematic perspective, I think sentiment is still remains pretty negative. Number one. Number two, from a legislative side of things, and we don't like talking politics at all, but there is going to be some deregulation coming. What the Fed is doing in terms of the balance sheet, in terms of the restrictions on what banks can do, is starting to lessen, which is good because if you're a parent, sometimes you have to overcorrect your children. Well, the Fed and the regulators overcorrected the financial system in the United States. I'm not saying it's time to party or anything like that, like 2008, but we're not going to be anywhere near that. So I think they've unjustly treated the banks. So our theme for the banks and financials in the United States are the really big ones and the really small ones. The really big ones have scale. They have multi-divisional assets. They have the consumer bank, the commercial bank, the investment bank, and wealth management. We like all of those businesses, especially wealth management side of things. The small banks, at the end of the day, this is still a relationship business, Jimmy. Before we started talking on this, we talked about, I was at Merrill Lynch. We talk about our careers, and this is the relationship business, and that's why the small banks, the really small, clean banks in the United States with really great balance sheets and great commercial loan books are set to flourish. I think the ones in the middle, some of those, what we probably grew up learning as the super regionals, I think they're in trouble because they can't compete with either theme, right? They can't compete on the relationship side, and they can't compete on the scale side. So I think there's going to be some consolidation there, and some super mergers, but there's no reason not to own them before then and own scalable assets like the brokers, like the asset managers, and like some of the banks that I mentioned.
So you touched on AI, and I agree with you 100%. The one thing that AI will never replace, and that is relationships between individuals. But with regard to AI and just tech in general, do you have any names that you want to mention?
Yes, I think you don't have to own everything. And we came into this year neutralizing tech after being overweight tech for a number of years, and we were concerned at the side before coming into 2026, and we wrote about this in our year ahead piece. We don't like sectors in the U.S. that are over 30%. I mean, that really worries us, and tech was over 30%. And so part of our whole mantra is the conviction in terms of how we invest, and you don't have to own everything. And so we were underweight in our portfolio work, the Mag 7 in 2025. It helped us because we massively outperformed, and we're underweight this year too, and we're massively outperforming. So you don't have to own all of them. You can own some bigger positions in some of them and smaller positions in others. And so that's kind of what we thought. So to answer your question, we've gone through and said, okay, what are the best? What are the best themes going forward in terms of the software side of things? Who are the best companies? Who are the best management teams? Who have the best track record and some of the best themes? So Microsoft, we think, still has a war chest of cash. They've proven through the years that they've been able, especially in the last 15 or 20 years, that they can monetize some of these new products. And so I think they've unjustly been thrown under the bus. Same thing with Oracle. Oracle has more cash on the balance sheet than the country of Canada. However, people are penalizing that company because they went out in the public marketplace to go get some cash. They don't need it. The only reason why they did is because they didn't want to use their balance sheet because they've got some other acquisitions that they're going to make. So I think those two of the big ones are some of our favorites. From in terms of the overall product line, Palantir, because of the product that they have, the vision of the CEO. Now, this was a meme stock, and I was very against meme stocks in 2020, 2021. I thought, what the heck is this? But then I listened to a presentation from Eric Karp, and I'm like, holy smokes, this is an amazing company. And then I dove into the products a little bit more. So we have a position there. We're not massively overweight, but we think that's going to be a winner. And then lastly, I think cybersecurity, which has been hurt here the last week or so. If you think about where this world is going, they know where you are, man. Wherever you have this, man, they know where you are. So I think a name like Palo Alto has been a name that we've owned for a long time, that we're sticking with. Great management team, made a great acquisition in CyberArk late last year, another stock that we owned in our small mid-cap portfolio. So I think from a thematic perspective, again, you don't have to own everything. Now, lastly, in terms of what's going on, I think the problem with AI and the software was you were throwing out these supposed revenue numbers, right? And then all of a sudden, the expenses that you're paying for these AI platforms, oh, they're not matching up what you're doing in terms of revenues. And I think that's in a simplistic way, kind of freaked out investors. But here's the good news with the melees or the conflict in the Middle East, that kind of cleaned up things. So while everyone was worried, like you said in the beginning of the podcast, but everyone was worried about AI and private credit, everyone's so laser focused on what's happening in the Middle East. That kind of did what it was supposed to do. And the companies are coming out with their earnings and kind of proving that they're going to be okay. And so for all intents and purposes, where we're invested, we feel very confident about.
And you mentioned Microsoft. That's a name. I don't own it, but I'm watching it all the time. They own, I think, 27% of OpenAI. The weakness we've seen in Microsoft, is it because of this ownership in OpenAI and the valuation of OpenAI and whether or not they're going to get the valuation that they're hoping to get when they go public? Or does it have more to do with their software?
I think it's a combination, quite frankly, but I do think it's part of the rhetoric in terms of OpenAI and Anthropic and which is the better product and who and what OpenAI is going to be valued at when it comes out with. And plus two, you have the hullabaloo with respect to Sam versus Mr. Tesla, Elon. So who's the smarter person there? Again, you don't have to be the smartest person in the room, man. But I go back to Microsoft will weather the storm. I mean, I've owned Microsoft. I've been talking about Microsoft as an investor since the mid 90s. And remember, Microsoft had a lost decade. People forget about this. Microsoft had a lost decade between 2000 and 2010. Well, after Bill Gates stepped down from being CEO, they had a CEO there for 10 years that nobody really liked. And it wasn't until Satya came in and really took things over and they started to monetize their new products. So I'm a believer in Microsoft. Doesn't mean you have to be overweight. And it's one of those names that we're not overweight in Magnificent Seven, but we want to be able to participate in what we think is going to be a rebound and recovery in that stock.
I want to get your thoughts on Netflix. This is once again, it's a stock I don't own, but I watch it and I use it all the time. It got up to 135 bucks last year, pulled back to 75. I think there was a lot of concern when they were bidding for, was it Paramount?
Warner Brothers.
Warner Brothers. Do you have any thoughts on Netflix?
Yeah, we love Netflix. Netflix is the Kleenex of streaming. That was been my theme for Netflix for 10 years. And we'll talk about the theme for streamings here after I talk about Netflix in particular. But we have the very good fortune of running a portfolio called U.S. Large Cap Fundamental Value, and we love to buy what quote unquote broken growth stocks in the value portfolio if we think from a tactical perspective for maybe 2 to 3 to 6 months in there. We've owned Costco in the past. We've owned Starbucks in the past. In our claim to fame recently is that we bought Netflix at $80, and because why it was being I think the stock was going to go up regardless whether or not they got the Warner Brothers bid. But when they didn't get the bid, we were feeling more and more that they weren't going to get Warner Brothers, so we bought it. And Netflix is an amazing property because here's why. I think the streamers, Netflix, Alphabet in the form of YouTube, which, oh, by the way, YouTube, if you take YouTube out of Alphabet, it's bigger than Netflix. Apple and Amazon, those four, they're going to own all sports within the next 5 to 10 years, probably inside of 5. And they're not going to be on broadcast cable anymore. And look what Netflix is able to do with the Christmas football, and they did the Major League Baseball opener this year. And so they're prime. They got lots of cash, and they've got in the 3 C's of communication service, mean cash, content, and consolidation has been our theme for 10 years, and it's playing out. So here in the United States, you have Crave, man. You're blessed. So what are you gonna do tonight? I'm gonna watch Landman on Crave. You know what we do here in Naples? You talk to the people at the pool, like, oh, we're gonna watch that. I'm gonna watch Landman on Netflix. They think it's on Netflix. They think everything's on Netflix. No, Landman's on Paramount. So we have all these different streamers here. So there's still a lot of consolidation that can happen.
Yeah, it's the same way in Canada. It drives me insane. I probably have, I don't know, 8 different subscriptions. So you mentioned YouTube, and I got to say, this is
Yep.
becoming probably the number one in my household. I watch 1 to 2 hours on YouTube every evening, and it's just there's 110 million channels on there. When you and I were growing up, we were watching cable TV.
Right.
We thought we had a lot with two or three
With
hundred
the rabbit
channels.
ears, with the rabbit ears.
Now there's 110 million channels, which is just insane. But what about Spotify? Any thoughts?
So People that know me for a long time know that I love Apple. I love Apple stock. It did amazing. It's done amazing through this malaise in AI, and they're so smart. And so I never thought I'd find a company that's better at something that Apple does, and it was Spotify. And I bought Spotify when we originally rolled out our small mid cap portfolio a number of years ago. And it was like a $7 billion company. Now it's like an $80 billion company. We had to graduate. I love when your kids grow up. We graduate to our large cap portfolio. I think that's an amazing stock. So it's like 2 weeks ago, I think it was 2 weeks ago, they increased their price. It's just like Netflix, increased their price, nobody cares. Why? Because you need Spotify, you need Netflix. It's become more of, I think some of these names have become more consumer staples. And so Spotify is an amazing company. I ultimately think in the marketplace, they're also going to win in terms of some consolidation and kind of get into some other businesses over the next few years.
Yeah, it's interesting. So my kids are all over Spotify, and that's probably their number one or number two uh, platform that they like to listen and watch. But it's interesting to see Spotify. It's becoming more like YouTube. YouTube wants to become more like Spotify.
Yeah, well, I was funny when you're talking about YouTube, and I was talking to somebody else about this today. My grandson was here over the New Year's, and so now he's got his own profile on my YouTube channel because they're watching all these videos. He's 2 years old, man, but he, I mean, the intake. Now, what you have to do in Canada, man, you need YouTube TV. YouTube TV is amazing. You need to get that in Canada. You should push that. You should push that through the regulators.
Yeah, you're right. Do we have YouTube TV?
I don't
Uh,
think you do.
yeah, I know I subscribe to the football, but that's only on Sundays, I believe, right? But
Yeah, the
once
Sunday
again,
NFL ticket.
yeah, I love what YouTube is doing with sports and Netflix too. Like Netflix is
For
they're going
sure,
all
for
in on
sure.
sports, and I love that. I got to ask you about one more sector in the U.S. just to get your thoughts. I mean, all we ever hear about now is Ozempic or this other one called Mounjaro. And I read recently that 12% of Americans are on some sort of GLP-1 drug. Any thoughts on these big pharma names?
We're scared. We're scared about weight loss drugs. We enjoyed Lilly's great performance in 2024, and at one point, in the first quarter, I believe, of 2025, people probably don't know this, but Lilly was a Magnificent Seven stock when it, and I got scared when I saw that. And I've owned Lilly off and on for 25 years because great Indianapolis company. They usually have very good leadership. They've got a great CEO now. And so we sold half the position in 2025, and then we've recently been nibbling again because it's not about their weight loss drug. It's about all these other. They've been really smart in terms of diversifying out from the weight loss side of things and been very, very, very clear in terms of their path with respect to new drugs. We only own names like Merck and Pfizer in Amgen in our dividend growth portfolios and value portfolios because there is some intrinsic value there. But big pharma is a place that we've been avoiding in terms of being overweight. We've been more overweight names like Gilead from the biotech side because of the cash side of things. And at the end of the day, they're going to cure cancer, they're going to go into hepatitis, or they're going to cure something. Biotechs are the place to be relative to, let's say, vaccines. We have never owned Novo Nordisk, nor would we ever. I worry about the 20 years from now, what we're going to find out about some of these healthcare, or I'm sorry, some of these weight loss drugs, and so we've kind of stayed clear of that.
Yes, I share the same sort of concern, but you got to wonder, so if 12% of Americans are on these drugs now, when they become like strictly pill form, you can only imagine that it's going to double or triple.
I know, but so here's the great thing: there's 8,000 stocks. If you missed that one, there's going to be another. There's going to be another one out there, and so that's why. I mean, I think I worry about that. That's why for instance, we don't own certain things like Philip Morris and all that kind of stuff because maybe the stock's done really well this year because of the more defensive side, but you can't get everyone, and so we're going to stick to our guns and be worried about that.
Now, I want to ask you about the U.S. economy. I know you're not an economist, but I still want to hear your thoughts. And like very much like the S&P, the U.S. economy has been very resilient. The last non-farm number that we saw for the month of March, it came in at a very strong 178,000 additional jobs. The unemployment rate continues to tick higher, 4.3%, but historically speaking, still very low. Do you have any concerns about the U.S. economy?
No, we don't. Everything that we believe will be reflected in the stock market before the economy goes into recession. Stocks lead earnings, which lead the economy. And it's not. I'm not trying to be flippant about the economy, but at the end of the day, no one's talking about the strong employment. Everyone's worried about inflation. Remember, the Fed has a dual mandate. And if you're talking about less than 5% unemployment, and we're complaining about the Fed, and we're complaining about the economy, I think many people forget that you're supposed to buy consumer discretionary stocks when everybody thinks they're going into recession. You got to think in reverse. The U.S. consumer, we're good at a lot. We're good at a lot of things here in the United States, but what we're really good at buying stuff. And so we always find the right places to buy things, and we're really smart about spending our $100. And that's why I think it's become increasingly difficult to pick restaurant stocks or pick consumer discretionary stocks or try to pick the bottom in some of these housing stocks. Is the U.S. consumer has become exceedingly frugal, I think, and smart on how they're spending money. So I'm not worried about the economy, the inflation side of things. Inflation goes up like an elevator and down like an escalator. We do believe the conflict is not going to last as long as everybody thinks. You need demand destruction to take place with the consumer with $100 plus oil for not 3 to 6 weeks. You need it for 6 to 12 months. That's what the analysis shows. And I just simply don't. I simply believe that that's not going to occur.
Well, very good point. So let's move on to the country of Canada, a place that's near and dear to my heart. And before I get your views on the markets and also the Canadian economy, I'm going to throw out a quick couple of fun facts at you. So the University of Oxford, they published this happiness index. It comes out once a year. And do you want to guess where Canada was on this list out of 147 countries?
Gotta be. People are so nice in Canada. It's got to be near the top.
Nowhere near. Okay, it was number 25, and that's versus
Okay.
the US, which was number 23. Finland has been at the top of the list for the last 9 years, believe it or not.
Wow.
I'm going to throw out one other number at you here before I get your views on the economy. But 2025 marked the first time in Canada's population declined. It declined by 102,000 people. That's the first time since Confederation, which was 1867. Can you believe that?
No. No. That's actually surprising, especially given the of what the immigration rules are there. So that's surprising. Those are fun facts. I like that. The Finland thing. They've got Finlandia vodka there. That's probably why it's really good. And people are generally happy there. I knew the Finland thing, and so I think that it might be with respect to some of the regulations and the government stuff there that makes things a little bit easier to live there. So
So I think one of the big concerns for me as a Canadian is the number of people leaving. Okay. Now, if these are people that aren't contributing to the economy, no problem, go. But if these are educated people that can really contribute to the growth of the economy, and I'm guessing they are, right? Because if you leave one country to go to another country, you got to have some sort of means to support yourself. I
right.
think that's a big concern. But why don't we talk about the TSX now? It had a very good 2025. It was up 30% on the year. Big part of that growth came from resources, more specifically precious metals. What are your views on the TSX? Do you think we're going to have another big year like that?
No, we don't. We were fortunate enough in our strategy research to go bullish Canada mid 2024 in our written work. People, it's out there in the www.hintersphere. And people thought we were crazy. But anytime that you have the big three doing what they do, but especially having gold outperform the way that it did, it typically ushers in, especially for resources, at least a 2 year period of underperformance relative to the index. In terms of banks, which in the financial sector, which I talked earlier about having a sector in the United States over 30%. Well, clearly, financials are over 30% of the TSX. But the banks, I think, are going to have a more challenging year, especially considering that a big majority of their growth was really fueled by these over reserves. The banks over reserved in 2021, 2022, and part of 2023. We wrote a piece that said caution that, hey, this is great, but typically and historically over the last 200 years, when banks over reserve, they have a 2 to maybe 3 year period of outperformance, and then they underperform. And so I think there's a good chance that the banks may have gotten ahead of themselves. I know gold has. And the reason why I know gold has is that I know how to make friends and influence people. Canadians aren't going to like this. But anytime gold on a year over year basis is 2 standard deviations above the long term average performance on an annual basis, it typically and historically underperforms for 2 years. So coming into 2026, gold was at 4 standard deviations above. And so we've been very cautious. We own Agnico. That's about it in our portfolios because I think it's a great company and they're paying dividends and all that kind of stuff. But at the end of the day, we've been more cautious on that, and it's been the right call. If you take a look at year to date, but more importantly, when the conflict started, gold underperformed. So that should be telling you something because you can't fall back on the gold is a reserve currency, end up being a reserve currency, and the dollar doesn't matter anymore. I think a lot of the gold trade last year, quite frankly, was due to U.S. hatred. And then the momentum got going. And then what happens in momentum is people start jumping on and then it really goes. And I think that was exactly what happened. And so again, I'm not, no disrespect. I think you have to be kind of careful. And the other great thing about if you're negative gold and more cautious on the banks, you have to remember in Canada, there's all these other stocks and all these other sectors that no one ever talks about. And I think there's great opportunities in Canada to take that money and buy those stocks.
So let's talk about some of the names. What do you like?
I love Aritzia. I do. I think it's a stock that most Canadians don't own enough of. The way that they run the company, the way that they run their expansion, the way that they display their merchandise, the way that when you go into a store, how they talk to you, how they treat you, it's amazing. Now, I think a lot of people have, fears that they're going to get too big like Lulu. Lulu's a Canadian company, even though it's listed in the US, and Lulu's kind of fallen on itself a little bit, and that's okay. It's another one of those broken growth names that we actually own in our value portfolio now. We think they're going to right their ship. Anyway, or they think it's like Canada Goose. Remember, Canada Goose kind of was really exciting, and then they overexpanded, and now they kind of retrenched. I don't think it's either one of those. Management's really smart. They've got a great product. They treat people well. And again, I think it's a name that not enough Canadians own.
So I have two daughters, and one of them owns Aritzia, and I asked her why she bought it, and she said because I love the store. She shops there all the time, and it's been a huge winner. I think in the
It,
last 2 years, maybe.
yep. Well, I mean, we bought it in 2018, 2019, and owned it ever since. And it's been a great performer for exactly the reasons that your daughter talked about.
And what other names? You mentioned you think the banks, the Canadian banks, are going to be under pressure.
I think
Do you
some
have,
are. I think
right?
some are. I think you have to be. I think it's going to be a period where you don't go buy a Canadian bank ETF. You're going to want to be in more of the individual names. And so from our perspective, RBC and National are our favorite. I think probably CIBC would be the other one. But I think some of the other banks, I think they've kind of gotten ahead of themselves. I think you need to kind of take a look at Intact and Manulife in terms of some other Brookfield to be a little bit more diversified in financials. In terms of stocks that we love Waste Connections. I think Waste Connections is an amazing company. 80% of their business comes from the United States. Couche-Tard is another one. Talk about one of my favorite themes in Canadian investing is capacity versus scarcity. And the scarcity theme for Couche-Tard is it's one of the only consumer staples names that actually continues to grow and has a very strong track record of how they deliver earnings and how they run the business. Circle K was a U.S. company, and they came and bought Circle K and then rebranded themselves. They're very, very smart operators, and Couche-Tard is one of those companies that I think is very, very well poised to do well.
And we didn't talk about oil at all. It's trading at or near $100 a barrel. A lot of these oil companies in the US and also in Canada are making buckets of cash flow. What are your thoughts on that sector?
They're making buckets of cash flow for about a quarter, but I think that you need I think it's $85 or something like that. You need plus for especially some of the U.S. oil companies to make money. C&Q is the one in Canada that's more tied with respect to correlated to WTI and Western Canadian Select. We own some of that stock, but we like Enbridge and TransCanada. and Suncor because of the dividends and the consistency with respect to how they run their businesses. We don't really go out on the realm in terms of more risky or smaller cap. We do think we've said this for 15 years now. That we do like Canadian oil and Canadian energy companies better than U.S. energy companies because U.S. energy companies are actually more dependent on higher price oil and are much more cyclical. And so we own Chevron and Exxon, but that's about it. And we own a little natural gas company and because we think that's going to help fuel AI and utilities. But U.S. and I'm sorry, energy in the U.S. is 3%, so it's not that big of a deal as energy in Canada.
Now, the Canadian economy has been under pressure for quite a few years now, and even more so now with I guess, the trade wars or pending trade wars with the US. Canada's unemployment rate came out recently. It was 6.7% in February, up from 6.5% in January. The trend in the last probably year, 2 years has been up. Youth unemployment, believe it or not, Brian, it's over 14%. But do you have any concerns about the Canadian economy, especially with this uncertainty associated with the trade agreement with the US?
I think the Bank of Canada has done a pretty good job providing liquidity. Number one, now you have a prime minister that used to be head of the Bank of Canada. So I think he understands the whole monetary part of things probably better than some other previous leadership there. I do think that Canada is going to have some struggles in terms of their economy, but at the end of the day, I think the names that you need to focus on from a stock perspective, investing, are the ones that are focused more on the deliverables and growth within the U.S., some of which that I mentioned. I think when you're trying to do deals with Europe or trying to do deals with China, which are both by the way, diminishing assets in terms of their importance of the world, in terms of world GDP. Eurozone's down dramatically the last 10 years. China's importance of the world is down dramatically over the last 10 years. So I question that type of thinking a little bit from a longer term perspective. But at the end of the day, you can't change the proximity of Canada to the United States. You can't change that. And so I think let's take two steps back and just know that we are going to be friends. We're continue to do business, focus on those names. And then in terms of the Canadian economy, just it's going to continue to chug along. I always wonder too, at some point, do the banks and the Bank of Canada have to change something with respect to some of the mortgage rules in Canada? Here in the United States, we're blessed and fortunate to have this thing called 30-year fixed mortgages. And so, I think some of the housing boom was due to how you manage your mortgages in Canada. I think some of the opposite is happening right now. So something more consistent from a product perspective would be really interesting to see what that would do to the housing and the economy in Canada.
Well, Brian, this has been a great discussion, and I want to thank you very much for spending time with us today. And as we wrap up, you mentioned at the beginning that you and your team created 3 new ETFs, and why don't we end right here? Maybe you can just touch on those ETFs again, and if somebody would like to learn more about them, where can they go?
You can go to humilisinv.com. We list them. Our fantastic turnkey partner, LongPoint, is the one that has put out the ETFs on our behalf. And so we're running an ETF, which is called Fundamental Opportunities. That is 2/3 Canada, 1/3 US. So we're layering in the best of the US with Canada's really best companies. So the very best of the US with the majority of Canadian companies. Then a North American dividend growth opportunities ETF, I'm sorry, which is 60% US, 40% Canada, but really focuses on growing the dividend over time. A lot of investors need income, and so we provide income through that. Then lastly, our North American tactical ETF and mutual fund, which is 75% US and 25% Canada. So the creme de la creme in Canada is in there. It's really driven by the themes and fundamental prowess of the US market. And so they're back out in the Canadian marketplace as of March 31st, and we're excited to be back in Canada.
And if somebody wants to check these out, they all trade on the TSX?
They all trade on the TSX. Any person in Canada can buy them. And if you want more details and more information on that, we have all the portfolios written up and how we run them, our process, our discipline, all of that on humilisinv.com.
I will include a link below in the show notes. Brian, once again, thank you and good luck in the markets.
I really appreciate it. Thanks so much. And stay warm. Although it's spring, man, it's going to get better. It's always going to get better. Thank you so much.
Thank you.